That's before we even talk about default, because this is where bridging finance really becomes unforgiving. If you fail to repay on the agreed redemption date or breach certain loan terms, default interest can apply. That rate can increase materially from 1% per month to 1.5 or even 2%, sometimes compounded daily. Over a few months, that can erode a significant proportion of your projected profit. Most investors assume that if their exit is delayed, they can simply extend the facility, but extensions are not automatic. They involve a fresh valuation, they may even involve new underwriting. They frequently involve additional fees and sometimes a higher rate. If the property is revalued lower than expected, perhaps because the market has softened, your loan-to-value ratio increases. The lender may require a capital reduction before agreeing to extend, and if you can't inject the additional funds, your position may become considerably weaker. And this brings us to the real risk in bridging finance. It isn't the headline rate, it's the refinancing assumption. Many investors use bridging as part of a buy, refurbish, refinance model, or BRR. On paper, it works neatly. You purchase below market value, improve the asset, refinance onto a longer-term mortgage, and recycle your capital. But the refinance depends on variables that are sometimes outside of your control. Revaluations, rental stress testing, lender appetite, market liquidity. If the valuation comes in 10% lower than projected, your leverage increases immediately. If rental stress tests tighten, the mortgage may fall short of what you need to clear the bridge. If yields don't stack as expected, you may need to inject additional equity to complete the refinance. And in a rising market, these risks feel theoretical. In a flat or illiquid market, pretty much like what we have now, they become very real. If the exit fails entirely, meaning you can't refinance or sell within the term, enforcement mechanisms begin to apply. The lender may issue formal default notices. They may appoint Law of Property Act receivers. Receivers act in the lender's interest, not yours. Their mandate is to recover capital efficiently, not maximise your upside. That can mean a quicker, more conservative sale than you would have chosen